Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Discovery stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Discovery owns the TV stations Discovery Channel, Animal Planet, Science Channel, and TLC. In 2018, it acquired Scripps Network Interactive. That added Food Network, HDTV, and the Travel Channel to its portfolio. In the fourth quarter of last year, it started offering streaming services through Discovery Plus, and they already have 20 million subscribers. Discovery Plus started with over 50,000 streaming shows. Since they create so much original content, they have a lot of shows that they don't have to pay for. Where a company like Netflix, they started with nothing and they had to pay through the nose to acquire so much content. Discovery also owns versions of its channel brands in international markets. Its programming can be found in 220 countries and in 50 different languages. The company claims it has 3.7 billion viewers or subscribers throughout all of its platforms. That means half the world views its content. In May of this year, AT&T announced that it had proposed a merger between Discovery and its subsidiary WarnerMedia, which will be spun off into a new publicly traded company. Discovery shareholders will own 29% of the new entity, and AT&T shareholders will own 79%. AT&T paid $102 billion for Time Warner 3 years ago. It plans to sell Time Warner for $43 billion to Discovery. This transaction was set up as a reverse Morris trust, which allows a company to spin off and sell assets while avoiding taxes. Discovery is headquartered in New York, and was founded in 1985. It trades on the Nasdaq, Deutsche Borse, Mexican Bolsa, Vienna, EuroTLX, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $26 a share, and they have 506 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they do have lots of free cash flow, and it's pretty consistent year to year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was lowest in 2018, highest in 2019. Revenue is the sales for the company. That's pretty consistent, around $11 billion a year. This is the company's income statement. The top line is the revenue of the sales. Here's a breakdown of their 2020 revenue. $5.6 billion from advertising, $4.9 billion from distribution. Their international revenue is pretty strong, $3.7 billion of the $10.7 billion. Advertising revenue is mainly from the commercials you see when you watch their programming. Distribution revenue are fees paid by third parties that use their content on their platform. Like if Netflix wants to use some of their content, they have to pay Discovery a fee. Also part of distribution revenue are the fees paid by subscribers using Discovery Plus, and also video-on-demand services. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months at $7.1 billion. Below that is their operating expenses. Then below that is their operating income. And that was lowest in the trailing 12 months due to higher operating expenses. Their expenses went up a lot in the trailing 12 months because of Discovery Plus. They had to do a lot of marketing, acquire some content, and other related costs. This is a breakdown of their 2020 expenses according to their 10K. Cost of revenue was $3.9 billion. These are all the costs involved in creating their content. And the great thing is, when they create their content, they can make money off of it. So it's an asset. They can monetize that asset and sell it to other companies. They can also use it on Discovery Plus and make money that way. They spent $2.7 billion in SG&A. This includes things like payroll costs and marketing. They passed through $1.4 billion in depreciation and amortization. This is when you decrease the value of an asset on your balance sheet and pass through a loss onto your income statement. So it's a non-cash item. It's an accounting loss, not a cash loss. They had a small amount in impairments and restructurings. They do have a good amount of debt on their balance sheet. They spent $644 million in interest on their debt. That was lower than 2018, 19, or 2020. They're going to assume $1.5 billion of debt from the Time Warner merger. Also, they have to pay AT&T $41.5 billion. So they either need to issue more debt or dilute the shareholders. And their market cap is a lot less than $41 billion, so they can't dilute the shareholders 200%. So they're likely to take on a lot of debt. That could mean they add $43 billion of debt. At a 3% interest rate, that's $1.3 billion of interest on their debt. But of course, they're going to generate cash flows from the Time Warner acquisition. So if they could generate $1.3 billion of cash flow, they'll break even. If they generate less than that, they would have been better off not acquiring Time Warner. But we have to assume when a company acquires or merges with another company, they're doing it for the best interest of the shareholders. So hopefully Discover generates more than $1.3 billion of cash flow from the Time Warner acquisition. But nobody can predict the future, only time will tell. And the bottom line of the income statement is their net income, which is pretty good each year. It was the lowest in 2018 because they passed through an $864 million write-off. And this is a non-cash item, so it doesn't affect cash flow. It's an accounting write-off. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they generate a lot of cash flow. $2.5 billion was the lowest, up to $3.4 billion. They do spend a good amount of money in CapEx, $352 million in the trailing 12 months. In the company's 10K, they mentioned Discovery Plus is a big part of their CapEx spending. Operating cash flow minus CapEx gives you your free cash flow, and they have lots of free cash flow remaining. They don't pay a dividend, but they do buy back stock. They bought back $600 million in 2019, $1 billion in 2020, and about $500 million in the trailing 12 months. When a company buys back stock, that decreases the shares outstanding, which makes your shares more valuable. And they also pay down debt each year. In 2019, they issued $1.5 billion, but paid down nearly $3 billion of debt. This is the equity section of their balance sheet, and they have $11.5 billion of equity. They raised $11 billion from selling their business, and they profited $9.4 billion from running their business. They also bought back a lot of stock, over $8 billion of stock. And they have a $13 billion market cap, so they bought back almost as much as their market cap. When a company buys back stock, they take it off the open market and put it onto their balance sheet as treasury stock. So that decreases the shares outstanding, which gives you a bigger piece of the pie. And this brings down their equity value. So to calculate their equity, it's additional paid-in capital plus retained earnings minus treasury stock. So if a company buys back enough stock, it can get negative retained earnings, like Boeing and Starbucks. But they could just reissue this $8 billion of stock if they wanted to, and that would increase their equity balance and increase their cash balance. Let's look at the capital structure. $11 billion of equity, $15 billion of debt. They're 43% equity, 57% debt. Their net debt is $12.2 billion, and their WACC, according to Simply Wall Street, is 7.51%, which is higher than Finbox, so I use that WACC to be more conservative. The higher the WACC, the lower your valuation. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $41 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $40 billion. We divide that by 506 million shares. And we get a calculated stock price of $79. They're trading at $26, so they're trading at a 68% discount. It's a strong buy according to the model. The average analyst projects their revenue to grow 3.5%. To calculate their future revenue, I grew at 3.5% a year for the next 4 years. To calculate their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that comes out to 23%. So I multiplied their revenue by 23% to get their future free cash flows. It does seem doable for the company to hit these numbers because all 4 are lower than their 2019 and not that much higher than in 2018. Simply Wall Street is higher than me. They're at $99 a share. They're saying the stock is 74% undervalued. 9 analysts priced this stock and the average price target was 36. The low was 26, the high was 52. So they're all below me and Simply Wall Street. This is where the stock has been trading the last 2 years. The stock was always trading below $40 until the beginning of 2021. Then it shot way up and it came way down. It came down a lot faster than it came up. In my last video on Viacom, I explained this in more detail how it happened. I'll give you the expedited version. Bill Wong ran Archegos. This is a family fund. He was using total return swaps to buy large positions in a few companies. Discovery is one of the companies he was buying a big position on. He would go to a lot of different banks and buy these swap agreements, which means he had to put up a small amount of collateral for a lot of stock. That's what you call leverage. This works great when the stock goes up, but if it starts to come down and he can't meet his margin call, the bank has to sell their entire position on the company. And what happens when a big bank like Goldman Sachs or Credit Suisse sells a big chunk of Discovery? The stock goes down. When retail investors like me and you see Goldman Sachs sell a big position on Discovery, we get scared and think Discovery is in trouble, so we sell our stock, which pushes the price lower. Archegos defaults on all their margin positions with all these banks, so they all sell the stock on the same day and it comes crashing down. And it comes down more and more because investors are losing faith in the company, not realizing the crash was mainly due to one guy's company. The reason it ran up so much is because these big banks were taking big positions in Discovery. They were only doing it for this guy. So when we see Goldman Sachs buying $100 or $200 million worth of Discovery, we buy it as well. And that's why the price went up so high, but then it came crashing down even faster. And I saw a story saying this fund lost $20 billion in 2 days. It seems like Discovery is at a good value right now. But before the run-up, investors never felt the stock was worth $40. Even though my model is saying the stock is worth more, and there might be other analysts out there saying the stock is worth more, it doesn't really matter. The stock is only worth what investors are willing to pay. And obviously investors were never willing to pay more than $40 until this guy got involved and pumped the price up. So I do think there's a chance the stock will get up to $40, $50, $60. But it could take a few years for people to feel comfortable investing that much money in this company. They have a beta of 1.4, so the stock is a little more volatile than the market. It's gone up 15% in the past 52 weeks, while the S&P is up 32%. The 52-week low was 20, the high was 78, and the stock is trading below its 50-day and 200-day moving average. About 6 million shares are traded each day on this stock. All the shares are held by institutions, and 17% of the shares on float are shorted. So it has a really high short percentage. Their employee count seems to be going up each year. They're at 9,800 employees. If you put $10,000 into this company 10 years ago, you'd have $11,000 today. A few months ago, your investment would have been over $30,000, but if you're still holding on, only $11,400. That's only a 1.3% annual return. In the past several months, no insiders have bought the stock. There's only people selling the stock. And some people sold the stock at the right time. Look at this guy, 9,500 shares at $76. But even this person, 73, 73, 61, 58, they all got great deals because the stock came crashing down. The biggest shareholder is Advanced Publications. They own 25% of the stock. This is a private media company. They got the name because the first company they bought was the Staten Island Advance. I delivered the Staten Island Advance for 5 years, from middle school into high school. The next biggest shareholder is Vanguard at 8%, then BlackRock, State Street, and Hotchkiss and Wiley. Let's look at their financial ratios. They have great price multiples. This indicates the stock is really undervalued. Their PE is below 10, 9.4, much better than the market median and average. They have a good price to sales of 1.1. Their price to book is also 1.1. Price to book is stock price over book value per share. The way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. And they have 11 billion of equity, negative 12 billion of tangible equity, since they have 24 billion of intangible assets on their balance sheet. So they obviously acquire a lot of companies to get all these intangible assets. Their return on invested capital is 8.6%. They can cover their interest payments 3.5 times. They have a high ROE at 12%. They have a good current ratio and quick ratio of 1.9. They have 2.8 billion of cash on their balance sheet, 2.7 billion of receivables. They seem to be well capitalized. They generated over 2.1 billion of free cash flow in the trailing 12 months. They have 3.2 billion of working capital. So they have over $5 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 9 companies in the same industry as Discovery, and if Discovery has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're much better than average in PE, price to sales and price to book. They have a higher current ratio. They have a good ROE, the average is negative. They're pretty close to average in debt, and they are smaller than the average company at 13 billion market cap. The average is 79 billion. And they do not pay a dividend. Most companies in this industry don't pay a dividend, just Viacom. So to summarize, I have them trading at a 68% discount. But for some reason, investors aren't willing to pay more money for this stock. Maybe it's their content, maybe it's not exciting. But now that they have HBO through the Time Warner deal, maybe that will pump up their stock price. I think it's a good fit for this company to have Time Warner. AT&T wasn't a good fit for Time Warner because they're not an entertainment company like this one. So I definitely see big things in the future for this company, so I think it's a good long-term hold. And the CEO of Discovery seems to be doing a really good job at growing his business by acquiring other companies and also growing organically. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.